This is an RNZ podcast.
Hello and welcome to this episode of Your Money with me, Mary Holm. Thanks for taking just a few minutes to listen in while Jessie Mulligan and I talk through some useful ideas about how to make your money work better for you. Just remember though, this is guidance. Final decisions are up to you. Over to Jessie.
Let's go to money now, and our personal finance expert is Mary Holm, today answering listeners' questions about mortgages. Hi, Mary.
Hi, Jessie.
Nice to have you in, as always.
Thank you.
Now, something I was going to mention yesterday, and I didn't get round to it. We were talking yesterday on the show about World Vision and how you can buy a goat for a friend if you want to for Christmas. And I emailed you. I didn't hear back from you in time to mention it, but you have a list of ethical gifts on your website somewhere, don't you?
Yes. Every year in my Herald column, actually, I run a list of different charities that do this sort of thing, and there are a lot of them. There's about 10 or so. So, I mean, the easy way for people to find it, I'll be doing it again this year in the Herald column, but other than that, on my website, if you just did a search on the word Christmas, the last list should come up.
Great. Yeah, and it's part of a wider sort of push that you give annually on thinking harder about what you're buying for people. And
I mean, I think it can be actually quite fun to think about different family members. What would they like to give? And it's all a bit contrived because the gifts are actually. I don't think the money actually goes on a goat or whatever, but you kind of think what person would like to give a goat and what person would like to give some seeds for a garden and what one would like to give some books for the classroom or a toilet. So, I mean, there's all kinds of things, and it's quite fun to think of different gifts to give for different family members to be giving to the charity, basically.
This week on the show we're talking about mortgages, and no shortage of questions from people about mortgages. It's the major financial commitment of your life for most people, isn't it?
Yeah, it is. Yes, indeed. And I don't know, at any given time, a fair chunk of New Zealanders are going to have a mortgage, although probably a bit less these days because a lot of younger people can't afford to buy a house yet. But still, a lot of people with mortgages and a lot of people thinking about getting mortgages. And I think we've got about 5 questions we're going to try and get through today.
So here's the first one from Anne. I'm a woman in my mid-50s and I've just bought my first home on my own. It's been a daunting task. I don't know much about mortgages and I've been unable to find good explanations and advice by Googling. I've had a mortgage of $250,000 approved by the bank, but I've yet to sort the details as settlement is a month off. I was thinking a 15-year term might be best because of my age, but I'm a bit confused over how much to fix and how much to float. I earn around $120,000 gross each year. I've got two dependent children, so I'm not so hopeful I can pay much off early, although I may have money coming from my parents' will at some stage. Do you have any advice? This is a good one, isn't it?
Yes, it is.
Good chance for you to stretch your legs, Mary.
Covers quite a few aspects. And first of all, and I agree, when you first get a mortgage all on your own, it can be a bit daunting. So well done. But it's a neat feeling to buy a house and get that all sorted.
There's one respect, although they're not my favourite people, but there's one respect I found a mortgage broker quite helpful, because they've done it all before and they can answer all your stupid questions.
They can be really helpful, mortgage brokers. Just ask them which lenders they're working with, because they don't work with all the lenders. They do work with a lot of them. And so a good one can help you work out which is the best mortgage for you. But ask them which banks they don't work with, and you might want to keep an eye on what sort of rates they offer. And also just ask them up front what sort of commission they're getting, because they don't charge you money, but they get commission from the bank or other lender. And so it's good if you've got all that up front, go into them and say, okay, how do you get rewarded and how much do they pay you, etc. And then go ahead and use them, because a lot of them know a lot about the different bells and whistles different banks offer and so on, so they can be really helpful. So turning to Anne, one of her questions was whether getting a 15-year mortgage was a good idea. She's in her mid-50s, so I think that is a good idea, because then she's got a chance of paying it off by perhaps 70. And the other thing, the shorter the term the better, because you'll pay a lot less interest in total over the life of the loan. Have a look at mortgage calculators online. There's a lot of them. And if you use any of them really, to have a look at if she's borrowing $250,000, how much more interest she would pay if she had a longer term than 15 years. The shorter the better. Having said that, of course, the shorter the term, the more you have to pay each month. And so you've got to, make sure it's within your grasp to pay that amount. But I like the idea of 15 years for her. I mean, 10 years would be even better in a way, but she's got to have a feel for what she can afford. Then the question of fixed versus floating. It's interesting because I've always said do some of each, and I still say that. But I was helping out a friend the other day who was looking at his mortgage situation, and I was shocked at how much higher the interest rates are on floating at the moment. They're quite a lot higher, like 1.5 percentage points higher, that sort of thing. Go to the same bank and see what their fixed and floating rates are. It's a very big difference. It won't always be like that. And in fact, if you look at a graph back, say, 10 years, there are just as many periods when floating rates are lower than fixed. It just depends on what the market thinks is going to happen to interest rates in the future and money availability and so on. So it changes all the time. So that's one good reason to don't just look at the current rates and say, oh, fixed is cheaper, I'm going to go all fixed term, because but I hope everyone knows what we mean by fixed term. It's when the bank commits you to paying X percentage interest for 1 year, 2 years, 3 years, 4 years, whatever the term you've agreed on. Whereas floating, the interest rate's going to change on you as the markets change. It might go up sometimes and it might go down. And so fixed is lower interest at the moment, but I would suggest to Anne that she gets at least some of it floating, because it's much more flexible. And down the track, floating rates could go below fixed. In fact, they certainly will at some point. They have in the past, and, we just don't know when. And the advantages of floating are, and I think she sounds as though she's a bit aware of that, because she said she might get some money from a parent's will. Well, it sounds a bit horrible, planning that kind of thing. But let's be realistic. A lot of people might be interested in money from a will. People also sometimes get large amounts from redundancy pay that they don't expect. And with a fixed term mortgage, typically you can't pay much extra off until the end of the term. And, if you've got, say, a 3-year loan or a 4-year loan, you might be plonking that money into a bank term deposit in the meantime and earning very little on it. Whereas with floating rates, you can, by the way, pay a little bit extra off fixed rates, but and that varies. You should always ask your bank what the deal is, but you certainly can't go plonking in, $100,000 or something like that without a penalty. You'll be paying a penalty if you do that. So, good idea to have at least some floating, where you can pay off the amount. I think that's probably always true of floating loans, certainly nearly always. And you can also get variations on the theme, like offset mortgages or revolving credit mortgages are always floating. Just to go into them briefly, we have gone into them before, and we could spend the whole session talking about them. We don't want to do that. But offset mortgages, basically you are paying down the mortgage, but the amount that you've borrowed is offset by any money you've got in other accounts with the bank. Might be a savings account, might be your everyday account. And in quite a lot of cases, you can also offset it against other family members' accounts. So instead of getting interest on those accounts, everybody's balance is offset against your mortgage balance, and that can work very well. Revolving credit is a bit more complicated even, and maybe we shouldn't go into it much today because we've done it before.
We can always come back if we need to at the end of these 5, can't we? Yeah.
Yes, we can. Suffice to say that, Anne, I think it's a good idea to have at least some of it floating, maybe just 50,000 of the 250, something like that, to give you that sort of flexibility.
Great. Hope that helps, Anne. Martin asks, I took out a $200,000 mortgage 2.5 years ago on a 10-year period for a refurbishment. I took a 10-year term because I wanted it paid off by 2026, the year I turned 65. As well as making payments for the mortgage, I also make payments to my KiwiSaver, and my dilemma is that if I have any extra money, should I put it into KiwiSaver to build up my retirement fund or towards the mortgage so that I reduce my debt?
Yeah, no. My first answer to that is it's great that he's doing either. If you've got extra money and you've got any kind of debt, including a mortgage, it's a really good idea to pay it down. It's also a really good idea to put extra money into your retirement savings. And so rather than blowing it on something frivolous like a new car that you don't need, it's a really good idea to do either. Balancing up which one is the better one to do, the way to do that is to think about the interest you're paying on your mortgage versus the interest you'd earn on your KiwiSaver account. Interest, or it can be other returns in KiwiSaver, but we'll just call it interest here. It can include dividends on checks, on shares, etc. But we'll just call it all interest here because it makes it simpler. So if you were paying 6% interest on your mortgage, and you were actually these days it's more like 4%, let's say 4% on your mortgage, and you've got to compare that with what you earn in your KiwiSaver account. And quite often, in a lot of KiwiSaver funds, you'll be earning more than 4%, and that's where the trade-off comes. If you're paying 4%, and you can pay off some of that loan to avoid paying 4%. It's just as powerful for your wealth as earning 4% somewhere else. So that's the what you need to weigh up. But generally, even though quite often KiwiSaver funds have been earning more than mortgage rates are at the moment, that won't necessarily continue. KiwiSaver returns have been very high in recent times. They might be negative, they can be. That's not uncommon for your KiwiSaver fund to actually lose money. And because of that volatility, because sometimes it might earn more than your mortgage interest rate, but sometimes it might earn a lot less, I think it's a good idea to just put the money against your mortgage and get rid of that. It's a sort of lower risk strategy in a way to pay down the mortgage. But there's not a lot in it. Doing either is, if for whatever reason Martin sort of says, no, I'd really rather see my KiwiSaver account growing, well, I'd say then go ahead and do that. Just one other point about Martin. He's 10 years off turning 65, so he's 10 years off getting his money out of KiwiSaver. If you've got extra money, it's not a bad idea to put it into another fund, not into KiwiSaver, because then you've got access to get it out again if you suddenly find you need it for all kinds of reasons. So he might prefer to go with another fund and instead of KiwiSaver.
That operates just the same as KiwiSaver, but doesn't have the same restrictions of when you can get it out.
That's right, yeah.
Okay, thanks. Query for Jessie and Mary re mortgages segment this afternoon. What does Mary think of using KiwiSaver to reduce a mortgage? Once you're eligible to access your KiwiSaver, save money on interest and mortgage insurance, but not use all their KiwiSaver on repaying the mortgage.
Yes, and that came in from a woman named Claire. So it's sort of actually the same question as Martin's in a way. It's whether you have more money in KiwiSaver and pay, or whether you pay down the mortgage. So in her case, what she's talking about is reaching 65 and you've still got a mortgage, and then you've got, let's say 50,000 in KiwiSaver. At that point, is it a good idea to turn around and use that money as soon as you get access to it at 65 to pay down the mortgage? And once again, I tend to think yes, maybe not all of it. And she said she probably wouldn't use all of her KiwiSaver money because it's good to have some sitting there for flexibility for using on whatever else comes up. But it's not a good idea to be going into retirement with a mortgage, really. It's not ideal. So if you've got some KiwiSaver money you can use to whack against the mortgage, I think that's a good idea. Yeah.
Okay. How about this? Astrid wants to know, she gives us a bit of background first. She says, I'd like and have been offered bare land to buy with power, water, sewage, etc. in place. And I'd like to put a container house on it, partly to save costs and partly because of principles. I just want to buy a small house with a garden for myself, not a flash house. but also not something rubbish. So buying land and putting a container house on it seems a happy alternative. But now my KiwiSaver contact person says I can't use my KiwiSaver for it because the house and land needs to be appealing for a wide audience. First I've heard that. I think more and more people are interested in smaller houses, said Astrid, and not the ones with 4 bedrooms and 2 bathrooms and 2 garages with no garden. My question is there any way I can use my KiwiSaver to buy land to put my own house on it?
No, the quick answer is yes, there is. But first of all, I just want to say, neat idea, Astrid, the container houses. I wasn't sure exactly what she meant by that, and I Googled it, and there's some fantastic pictures that come up of, you can just put a house in one container, but people have done some really neat looking things with a couple of containers at different angles, etc., etc. So, great idea. Now, and the fact that they're small houses, that they're quick to put together, I think they're, the thing of the future, really.
They do look cool, don't they?
Don't they? Yeah, some of them are really creative and neat. But anyway, I am not an expert on this using KiwiSaver money to buy a first home. And so what I always tend to do, if it gets beyond the simple stuff, is go to Housing New Zealand, which runs that aspect. Now, I should be clear here, there are 2 things about KiwiSaver and first homes. One is withdrawing money out of your KiwiSaver account, and Housing New Zealand doesn't run that. That's just run by your provider, your KiwiSaver provider. Housing New Zealand runs the Home Start Grant, which is money you can get to help you buy your home. So looking at both those things, I think Astrid is only wanting to withdraw money, but I've also got an answer about whether she might be able to get a grant from the government as well. So on the withdrawal of the money, the Housing New Zealand man I spoke to said, look, we're not the final say on this, providers are, but he said providers usually don't give much consideration to what actually goes on the land at a later date if you're buying a house and buying land and planning to put a house on. And he says, we don't think there would normally be an issue with the situation that Astrid has outlined for us. In other words, he's not saying that, he agrees that whatever she's been told about the house and land needs to appeal to a wide audience. I've never heard of that.
Not ringing any bells.
No, and I don't think that whoever gave her that advice, I would challenge that.
There's a special clause of the KiwiSaver where you get a bit more if you're building a new house,
yes,
right? Maybe there's something in there.
Yeah, I've not heard of it. I mean, I would certainly, if I were Astrid, go to someone else. Don't take that as the definitive answer. One other point that the Housing New Zealand spokesman made was that under the law, the withdrawal from a KiwiSaver fund has got to be used for the purchase of what they call an estate and land. And that means in her case, what she has to make sure she does is use the KiwiSaver money to buy the land, not to buy the container house. Okay. So just check all of that out before you start doing stuff, Astrid. Make sure you get that right. So that money should be used for the land, and use other money to buy the house, perhaps mortgage money. Just looking into the Home Start Grant, I realise we're getting short of time, but I think it's worth going into this. And our last question we might leave till another time.
See
maybe
how we go.
Even. Yeah. Because the Home Start Grant, which a lot of people don't know as much about as it would be good, is up to $5,000 if you've been in KiwiSaver and contributing for 5 years or more. Starts at $3,000 if you've been doing it for 3 years or more, and goes up to $5,000 at 5 years or more. Double that if you're buying a new place. And in her case, I don't know whether buying a container house would qualify as new or not. She'll have to look into that. But there is an income cap. You have to make under $85,000 for one person, and there's a house price cap, which is $400,000 to, I think it's $650,000, depending on where you buy it and whether it's a new house or not. All of that is on the Housing New Zealand website. But so Astrid maybe she makes too much money, but people in general should be looking at that. Also, people who used to own a home and don't own one anymore. because of a divorce or bankruptcy or something like that, they are also eligible for these grants under the right circumstances. So I really urge people to look on the Housing New Zealand website. It's all there and, fairly easy to follow. And it's money from the government that's very nice to get. But looking specifically at Astrid's situation, the guy said, you've got to be a bit careful if you're going for this grant and you're buying land and then putting a house on it. Just read through the situation and talk to Housing New Zealand about your own circumstances first, because if you do it wrong, you can miss out. For example, he says when you apply for the grant, you've got to apply before the settlement date on buying the land, and you've got to give details of the land purchase as well as details about the intended dwelling. And, for example, they might ask for a fixed price building contract on the house or property building you're going to put on there. They require the dwelling to be consentable and compliant with local regulations, etc. In other words, really, I really urge people to check out the rules before they go ahead and start signing contracts to buy land. I've had people write to me and they've blown it. They've already got partway into the process and haven't done it right, and then they're hoping to get KiwiSaver grants or withdrawals and can't do so. So really important to check that out first.
Okay. We have 3 minutes, so let's try and do this one.
Yeah,
Ray says,
sure.
I read in an English magazine some time ago that UK banks are starting to offer mortgages to older people, and I'm wondering if New Zealand banks are thinking of doing this. It seems to be eminently sensible given that we have a reliable income, a proven savings record, and we're probably very good budgeters. Plus the bank will get their money back when we die, which I think might be a few years away.
Yeah, oh dear.
I feel many of us may like to have a little cash for another holiday or improvements, but are reluctant to borrow using a reverse mortgage. What do you think?
Yeah, and I think that you might as well go with a reverse mortgage, actually. Ray's probably heard some scary things about reverse mortgages. In fact, we should do a whole session on them sometime soon. What we're talking about is borrowing money against your home and paying no interest and no repayments and no interest, no repayments. The principal, typically people do it when in their retirement and pay back the money when they die or when they move out of the house. Maybe even next time we could possibly do a session on it, because there's a lot of interest in it out there.
Okay, great.
Let's
do it.
Yes, and we could roll this question into that, really, because I think otherwise what Ray's talking about is borrowing money and then in retirement making payments back again, which just means you're going to have to borrow more money, really.
If you don't have an income.
Yeah, well,
She says we've got a reliable income.
Yeah, you should have New Zealand super in that, but you're still, if you were just doing a reverse mortgage, we're not making any payments on it, you can borrow less than, because, okay, she's got an income, but she's using that for other things. The way it all comes out in the wash, I don't see a lot of point in borrowing money in retirement and then paying it back. Instead of just simply borrowing less and not paying it back.
Yeah.
But perhaps we should look at reverse mortgages
All
next
right.
time, because there's a lot of interest in them, especially among older people, but younger people as well just like to know that's a possibility for them in retirement.
Okay, that'll be on Mary's next visit in 2 weeks' time. So if you're
Yeah.
interested in reverse mortgages, mark that one in your diary, 15th of November. Thanks for coming in.
It's a pleasure, Jesse.
Nice to chat. Mary Holm, who's collected conversations on this radio station, are on our website as podcasts, rnz.co.nz. Just go to the podcasts page.